Hello there. I'm happy to bring to you some first-time homebuyer programs that you might be interested in. So, in response to the rising interest rate market, first-time homebuyer programs are back in style and they've expanded to accommodate more buyers now. So, this presentation today is going to give you an overview of some of the benefits and options that first-time homebuyers have. So, first of all, the number one challenge that buyers are having today is with affordability. They're being squeezed in all directions. Home prices are higher than ever and rates are higher than they've been. But the reality is that the average mortgage rate over the last 50 years is 7.76%, which is actually higher than what it is today. So the rates themselves are not necessarily the problem, but when you combine it with the value of homes that has risen dramatically over the same time period, that is where the challenge really comes into play. It's all relative. We all know that the power of building equity over time makes it much easier for existing homeowners to improve their rates, their payments, and their housing in general. But what does that do for the first-time home buyer? It can be very challenging for today's buyers. So problem number 2 is down payment. This is an age-old problem, of course. People have been struggling with coming up with down payments for their first homes since the dawn of time, probably. Except now, the average price of the home in LA is $950,000 and a condo is $625,000. And closing costs are going to run at least $10,000 or more. So when we're looking at numbers like this, coming up with even a small down payment can just seem insurmountable. So it might take a bit of convincing sometimes and a bit of sacrifice to get renters to convert to buyers, but it's so worth it in the long run. Owning a home is a way out of the rat race, and it's a fundamental step towards building wealth. Renting might be a good short-term solution for some people, but it is not a long-term strategy. Rents represent perpetual death. There's no benefit to them, to the renter, and the obligation can sometimes get greater over time. Rents are also typically higher than mortgages. Renters pay the mortgage and then some. After all, why would somebody invest in rental property if their rent payment wasn't covered? So clearly, a mortgage payment is typically less than rent. So this is a really good example of rent compared to mortgage, or how much money you're spending in rent. So in this example, if you have $25,000 in rent, in 3 years you will have paid $90,000, and in 10 years you would have spent $300,000. So if you're paying rent, you're paying someone else's mortgage, so why not pay your own? Of course, there's other reasons to buy a home besides the financial reasons. I just want to put things in perspective. It's actually very easy to go with the flow and just pay rent. Taking the steps to start buying a home requires motivation. It's my job to tell you that homeownership is doable, and maybe you just need some direction. Maybe you need some advice. Maybe you need a game plan. It would also be good to understand why you're doing this. I know in my case, before I owned a home, I had kids and animals, but my animals are important to me. I've got 5 of them right now. It's not so easy to rent a home when you've got these kinds of situations. So these are the big rocks when it comes to getting a loan, and this is what we look at. So in terms of assets, do you have a down payment? Do you have closing costs? And in some cases, do you have reserves? As far as income, do you have a 2-year history? We always do a 2-year look back and a 3-year look forward. Is that income expected to continue for at least 3 years? And can you document having received it for the last 2? There are all kinds of great programs for self-employed people. They may or may not be part of this first-time home buyer situation, but regardless of what your income situation is, I strongly encourage that you let us have a look and let us see what you can qualify for. We'll always start by looking for the best programs for you, and we'll get creative as need be. Credit is also an important factor, but so are your debts, and your debts and your liabilities. So let's talk about assets for a quick sec. Lack of down payment is usually the biggest barrier to entry, but as you can see from this slide, that doesn't have to be the case. Since there's mortgage insurance that's added to any loan that's less than 20% down, this does need to be factored in. However, keep in mind, you can get in as little as 0 and as much as you can possibly afford. The terms get better the more down payment you're able to put in. And this is another flyer that's available if anybody is in need of it. And let's talk about 0 down payment programs and all the various features. So we've got probably 6 different loan programs that can fit in this category, and every lender has different things that they require. So it's rather than put all the requirements of all the various lenders, I'm giving you a range in the various categories, and really everything's case by case, and you should really check in with your lender to see what's going to work for you. But maximum loan amounts are typically the maximum conforming limit. In some cases, it'll go all the way up to the $980,000, but in most cases it's limited to a maximum loan of $726,200. The minimum FICO scores vary. The lowest program I've seen is 600, but do keep in mind that many lenders will do a rapid rescore on your credit report. So if your score is lower than that, don't hesitate to attempt. Income limits may apply. So there are some first-time home buyer programs that will specify what the maximum amount of income is that you can make, and others that don't care. And typically the way these work is you have a first mortgage and a second lien. And the second lien is may or may not require payback in some scenarios. Closing costs are sometimes financed, and typically you can only do units up to 2. So a duplex, a single family, or a condo would be acceptable. And also PMI is required. That's your monthly mortgage insurance. There's also a $25,000 grant program that we're offering, and this grant goes up to $25,000. It goes towards closing costs. There's no repayment required and no lien on the property for that amount. And this is available on FHA loans as an add-on to FHA loans up to the $970,000 mark. And income limits on this one do apply, and the property has to be within an eligible census tract. But let me tell you, as far as the census tracts go, if the area is either low to mod income or has more than 50% of minority ownership, the property will qualify. Grant funds are reported to the IRS as income, and they are available on primary residence. That includes condos and 2 to 4 units in this case. PMI is required, but any upfront PMI can be paid using the grant funds. Here's 3 examples that I think are very telling. First is a 5% down program a 1% down program, and a 0% down program. You'll see that the purchase price is $650,000 in this example. We have mortgage rates in the 7-ish% range. So at first glance, it looks like the 1% program has the highest mortgage rate or interest rate. And then the estimated monthly payments are listed here. In this case, the 0% down program has the highest payment. And then your out-of-pocket costs, I wish I could get rid of my face here. Let's see, I think I can. Let me just see. No, okay, well. Camera, no. Okay, sorry, I blocked this. But in this case, the total out-of-pocket cost for the first option with 5% down is $46,000. On the second option, it's $20,000. And this option, which unfortunately you can't see because of my face, is about $25,000 to $27,000. So there's still, the important thing to note here is that even on zero down programs, you need some money to come in. You can't expect to just be income qualified and have no assets, no skin in the games. There's always going to be some funds that are needed to come in, unless of course you get that $25,000 grant that will go towards it. So once we get a client who applies for pre-qualification, two things are going to happen. One of two things are going to happen. One, they qualify. Fabulous. I pre-approve them. I provide a letter. They can go out and go shopping. Or if that's not the case, I give them an exact game plan. So they'll know exactly where they're short, what they need to do to come up with the funds or the income or whatever the scenario is, and they'll be ready to go forward in the future. So if they do get a game plan as opposed to a pre-approval, first thing we look at if they're short of funds to close is we want to exhaust all the resources that they have available. So I'll ask them, do you have the ability to get gift funds? Do you possibly have any retirement or brokerage funds that you could borrow from? And what about grant programs? Does your employer offer any grant programs? Have you done any kind of research to see if there's any government grant programs or private grant programs that you might qualify for? If it's still not enough, then at least they will know exactly how short they are and how much they will have to continue to save before they can revisit home ownership in the future. So if their debt ratio is too high, first thing I would ask is, can you get a cosigner? Can you pay off or pay down your debts? And if it's a condo, can you reduce or eliminate the HOA fee? The HOA fees vary pretty widely out there. So you may be looking at a condo that has, for example, a $500 fee, and maybe you can find one that only has a $300 fee, and that maybe is enough to make the difference. And if they have credit issues, there's a number of things we can do. So first of all, we can try to rescore them to get them a score. Here I put 660, that's sort of the ideal starting point, but regardless of what their score is, we can try to rescore it to get them a higher score. If they have late payments that are less than 12 months, they really need to go directly to the creditor and try to fix that, because that's a tough one. Late payments are really, really hard to work with, to fix. You pretty much just have to let them time out. Over time, they get less and less, have less and less of an impact on the credit score. So my advice in general is to just try to avoid late payments at all costs. Timely payments are the most important thing and the most controllable thing as far as credit goes. In a perfect world, if you can keep your credit usage at or below 30%, I also recommend, if you have questions on what your credit score looks like or your credit situation, go to annualcreditreport.com and pull your own credit. You're allowed to do that once a year for free. You don't have to pull all 3 bureaus, just pull one. TransUnion, to be honest, is probably the least beneficial one to pull. I would pull Experian or Equifax, and then check it very carefully to see if there's any errors and dispute those errors if there are. You can do it online, super easy. There's also Experian Boost, give it a try. And if you have any authorized, any family member, for example, who's got good credit, who could put you on as an authorized signer on an account, this could be helpful. You don't want to be authorized signer on an account that's carrying balances, because that's going to go against your debt. And don't let anybody run your credit to quote you a rate. It is never necessary. If you have an idea of what your FICO score is, that's what you should use. If you've had your FICO score pulled by a lender already, that's what you should use. Don't let anybody pull your credit just to give you a rate quote. So in recap, there's a lot of new down payment assistance programs out there, but they all have different variables. So please, I encourage you to explore the options with your lender. Your lender can give you guidance on how to prepare yourself to buy. And then we also have some flyers and things that can help you to understand what your capabilities are. And as an extra added bonus, I put in a few tricks that investors typically use that might be helpful for you when you're looking for your first home. So the first is, let's get creative. Let's talk about seller financing, subject to financing, and assumptions. So seller financing. What you should look for in this scenario is if the home is free and clear currently that is being sold. You're not going to know this. You're going to have to ask your agent to find that out for you. If it is, then the seller might be willing to carry it because they don't have a mortgage to pay off. But if the home has been on the market and isn't moving, if the buyer, the buyer, have a short-term exit strategy, for example, you need to sell your house, you're expecting a big bonus coming up, you're expecting some sort of payment and inheritance, something or other that's going to change your financial situation within the next several years, then that's good exit strategy. If the property is distressed, if the mortgage is hard to get, for example, you're buying land or a manufactured home, or if it's inherited property, and say, for example, that the sellers have inherited the property, they live out of town, the property's free and clear, they don't want the house, then they might very well be interested in carrying a note on it. So what is an exit strategy? That means that, I already mentioned that, departing residence, you might be in the process of selling your current home, anticipated income, bonus or inheritance, and also if you're planning to remodel, if you're buying a distressed property, and once you remodel and bring the value up, you're going to refinance it. That's a great exit strategy. Same with fixing and flipping. So let's talk about seller financing. The benefit to the buyer is that you can get better loan terms. Typically, you can come in with much less down payment and much less scrutiny. There's no credit reporting, so if you're an investor, then you can keep buying properties because this is not going to show on your credit report. If you're the seller, you have a lien on the property, so that protects you from any default that you might have to incur with the buyer. You also get a fully secured interest-earning investment vehicle that's earning market rates. And you can possibly get more money than you would if you were to sell it with regular bank financing. The docs that are needed if you are doing seller financing, the seller would need to put together a promissory note that spells out all the terms of the loan: the purchase price, down payment, interest rate, payment terms, and you can use a standard purchase agreement for this documentation. And there has to be a deed or mortgage that spells out the seller's rights and powers, what happens in the case of a default, etc. And these documents could be prepared by an agent and an attorney, and the buyer can pick up the costs for that. Now, on a subject to property, what you want to look for in this case is a seller that is financially challenged. In other words, they have delinquencies, debts, liens, maybe they're in pre-foreclosure, and maybe the property is distressed. This seller might be interested because rather than just lose the house to the bank, maybe they can get you to take over their mortgage, and your good payment history might actually help improve their credit as a result. And perhaps there's even some money left over that can go in their pockets. So on a subject to, you would be taking over the mortgage, but the bank wouldn't know about it. On an assumption, you would be taking over the mortgage, but the bank does know about it. So if, for example, the seller has a nice low-paying mortgage in the 2s or 3s, then it would definitely be beneficial. You cannot get financing today in the 2 to 3% interest range. So if you can assume that mortgage and take over the payments, that would be ideal. So it's important in these more creative options to know what your seller's mortgage situation is. If there's no mortgage, then you want to look and see if seller financing might be something they'd be interested in. If the mortgage itself is in distress, such as pre-foreclosure, you want to talk to them about subject to financing. And if the mortgage is attractive and it is assumable, then you want to talk to them about possibly assuming the mortgage. So there's one goal here, which is to get you into a home. And there's many solutions to do that. But you are not expected to, this is not a DIY thing. You can't do it yourself. You have to consult with the professionals. So check with your lender and your realtor and see what your options are. And I want to thank you for listening to my presentation. Here's my contact information should you need me. Appreciate it.